Happy 2018. I hope you had a great holiday season and a happy new year. I'm just checking in with you here at the beginning of the year. As you know, we have a new tax law that went into effect as of January 1st. And there are some pretty significant real estate ramifications in the new tax law. And I just wanted to go over those with you really quickly in case you hadn't heard about them or weren't sure exactly how they worked, or there were a couple different proposals out there. So you may have heard some different things. But anyway, on your mortgage interest, we used to be able to write off up to $1 million in mortgage interest, and there was a proposal to bring that all the way down to $500,000. The ultimate bill that passed, the compromise, was $750,000. So any new mortgage of $750,000 or less, you can write off the entire thing. If you're taking out a new mortgage more than $750,000, your CPA will do a calculation to write off up to $750,000 of it, the appropriate amount each year. So that's not as bad as the $500,000 would have been for Southern California, but we do expect maybe a little bit of an effect here in some of the higher end markets in Southern California. As far as property tax goes, there was also a proposal at one point to eliminate the property tax deduction altogether. The compromise, the final bill that the House and Senate got together on, capped the property tax and combined it with the state income tax and capped all of that at $10,000. So essentially, take your state income tax, throw in your property tax. If that's more than $10,000, you can write off up to $10,000. In Southern California, that's effectively eliminated the ability to write off property taxes for just about all homeowners or home buyers. Most people are paying at least $10,000 in state income tax here. So just keep that one in mind. The other change that didn't happen, which was a big win for the real estate market, was there was a proposal to change the current exemption on capital gains for primary residents. The old law, the old requirement was you have to live in your home for 2 years, or at least 2 of the last 5 years. And there was a proposal to change that to 5 years, or 5 of the last 8. In Southern California, we're a fairly mobile market where people do move frequently. It's not uncommon for somebody to live in a house for 2 years or 3 years or 4 years. And this will prevent people from being locked in and not being able to move if they want to move or have to move. So that's probably a win for the real estate market. Another couple of minor changes. Second homes still are eligible for mortgage interest and property tax write-offs at the same limit as the primary home, and that's combined. So $750,000 would be combined interest between your primary home and a second home or vacation home. If you're a real estate investor and you're doing a Schedule E, that really doesn't change at all. So you can still write off or still deduct or expense all of your property taxes and your mortgage interest on your Schedule E. That does not change at all. That's a little bit different. Those aren't deductions. It's an expense. Your rental property is really a business. So I hope that covers everything. We're still not sure exactly what effects all of this will have on our real estate market. It really depends on what segment of the market you're in, if you're a buyer, seller, price range, all of those things. If you want to review your situation and kind of see how these changes might affect you and what you may or may not do in the real estate market, give me a call or reach out. I'm happy to have a conversation with you. Beyond that, if you need good tax advice, let me know. We will put you in touch with a great CPA. I can't give you tax advice, but we have a great CPA that we can connect you with. So hope you have a great 2018 and look forward to connecting with you again.